Hi, my name is Jake Heitkamp. I'm an analyst at FactRight, and today I'd like to give you an overview of a few AR Global sponsored programs that currently require shareholder input or have recently obtained a strategic investment and been recapitalized. Before we get into those programs, let's set the background on some history regarding AR Global, leading us into the present, including the 2016 proxy proposals and subsequent strategic transactions involving AR Global sponsored investment programs. ARC, now AR Global, was founded in 2007 by Nicholas Schorsch and William Kahane. The group initially launched non-traded REITs, investing in single-tenant net lease programs, picking up on Mr. Schorsch's success investing in and repurposing closed bank branches. Shortly after founding ARC, the executives formed RCS to serve as a managing broker-dealer for these programs. RCS served as MBD on over a dozen investment programs, including non-traded REITs and BDCs. In total, AR Global raised nearly $20 billion in equity capital in the past decade and became the most significant product sponsor in the non-traded space. This slide contains strategic transactions and listing of early AR Global investment programs that provided liquidity and positive returns to shareholders. These included the listing of American Realty Capital Properties, which would later become known as REIT in September of 2011 on NASDAQ. Also, the American Realty Capital Trust in September 2012 was acquired by Realty Income, which was also publicly traded. This transaction provided the REIT investors with a 22% premium to the initial offering price. This premium is exclusive of distributions prior to the sale to Realty Income Corp. Additionally, New York Recovery REIT was listed on the New York Stock Exchange in April of 2014. A little later in the presentation, we'll circle back to New York REIT when we discuss ARC New York City REIT a little later on. Additionally, in June of 2015, Global Net Lease was listed on the New York Stock Exchange under the GNL ticker. This entity would eventually have AR Global Trust 2 rolled into it. And finally, ARC Healthcare Trust was listed and then subsequently sold on to Ventus for a premium to the initial offering price per share of about 13%, again exclusive of distributions during the life of ARC Healthcare Trust. As these transactions highlight, AR Global really delivered the goods for investors. These programs raised and deployed capital in the aftermath of the financial crisis and in short time frames, much shorter than expected in the non-traded space, realized liquidity events with very favorable results for shareholders. This backdrop of favorable strategic transactions and listings led to a virtuous cycle in which capital raising accelerated up to a high water mark of approximately $8 billion raised in 2014 alone. In 2013, RCS Capital Corporation was listed on the New York Stock Exchange under the RCAP ticker. In addition to serving as MBD on AR Global sponsored programs, RCS also included a retail advisory business which, through a series of acquisitions, came to include over 9,000 advisors with over $200 billion in assets under management. RCS came to have a market capitalization of over $1.5 billion at its peak. Business continued to hum along up until October 2014, when news broke that ARCP had misstated adjusted funds from operations on a couple of quarters of performance. Following this disclosure in December of 2014, Nick Schorsch resigned as chairman of ARCP along with the then-serving CEO David Kay and Lisa Beeson, president and chief operating officer of ARCP. In the wake of these disclosures, ARCP stock sold off approximately one-third of its value during the fourth quarter of 2014. Capital raising continued across the AR Global Investment Program platform during this time period subsequent to the AFFO disclosures. And in the third quarter of 2015, AR Global was in discussions with Apollo Global Management to potentially sell a 60% stake in itself for approximately $400 million in a cash and stock deal. This deal collapsed. However, Apollo and AR Global agreed to a distribution deal with RCS Capital Corporation set to sell Apollo-sponsored investment programs. Following this, in the fourth quarter of 2015, the Massachusetts State Securities Regulator charged RCS with fraud related to shareholder vote matters on an investment program. Following the charges, RCS broker-dealer registration was revoked in Massachusetts. Subsequently, RCS, a subsidiary of the publicly traded RCAP, paid a $3 million fine and wound up operations. Shortly thereafter, RCS Capital Corporation was delisted from the New York Stock Exchange and filed for bankruptcy in early 2016. This left the newly styled AR Global without its capital raising arm, effectively halting capital formation on a number of programs in the market at the time, including ARC Hospitality and ARC Healthcare 3, which we will highlight shortly. It is important to note that following the cessation of equity capital raising, AR Global sponsored programs including ARC New York City REIT, ARC RCA, ARC Healthcare Trust 3, and ARC Global Trust 2 put forth a series of proxy proposals in 2016. The proxy proposals included charter amendments which cumulatively reduced shareholder protections in the event of a roll-up transaction and diminished shareholders' ability to meaningfully participate in corporate governance of their respective investment programs. Charter amendments included increasing thresholds for shareholders to call meetings, increasing thresholds required to remove directors from simple majorities to supermajorities, elimination of the requirement of the board being comprised of a majority of independent directors, and additionally, reducing shareholder protections in the event of a prospective roll-up transaction, protections that included the requirement of an appraisal of assets prior to a roll-up and the right for investors to receive cash in lieu of securities in another non-traded entity. It should be noted that similar proxy proposals have been proposed by other product sponsors in the non-traded space and have been approved by shareholders in other non-traded REITs. As the charter amendments that were cited above are largely required by NASA and state securities regulators. So these aren't completely abnormal. However, in discussing these matters with many of you in the audience over the past year and a half, there seems to be a consensus that eroding shareholder rights and protections in the absence of a clearly articulated strategic proposal is putting the cart before the horse. Given that such a strategic proposal would require shareholder approval anyways, it makes sense that seeking charter amendments to execute on a strategic proposal could be put forth in the same proxy outlining a prospective strategic proposal. Throughout 2016, AR Global had significant difficulty gathering shareholder support for these proxy proposals, and numerous shareholder meetings were adjourned and delayed to allow for additional time for shareholders to vote on the proposals. The proxy results were a mixed bag, and in August of 2016, RCA shareholders approved the proxy proposals in their entirety, whereas ARC Global Trust 2 removed the proxy in its entirety and cited ongoing discussions of a strategic transaction with an undisclosed party. Additionally, ARC New York City REIT and ARC Healthcare Trust 3 shareholders rejected the proxy proposals in their entirety. It is important to note that aside from the aforementioned proxy proposals, mid-2016 through 2017 was a busy time for a number of AR Global sponsored programs, with a number of strategic transactions announced. These include, in September and November of 2016, Realty Finance Trust, a $1.4 billion mortgage REIT, and Business Development Corporation of America, a $2.6 billion business development company, each sold their advisory agreements to affiliates of Benefit Street Partners. Benefit Street, which features $17 billion in assets under management in its credit division, is a subsidiary of the private equity firm Providence Equity Partners, which has approximately $45 billion in assets under management. Subsequently, Realty Finance Trust was rebranded as Benefit Street Partners Realty Trust, Inc. Note that following these transactions, these investment programs are no longer sponsored by AR Global affiliated entities. BSP, Benefit Street Partners executives, assumed corporate roles in the respective programs, and both programs' boards subsequently had an influx of new directors from Benefit Street, coupled with the resignation of interested AR Global directors. Along with the change in advisor, there was a reduction in aggregate fees, including the elimination of acquisition and disposition fees, and the reduction in asset management fees due to a change in the calculation of the fee based on net assets as opposed to gross assets. In August 2016, ARC Global Trust 2 merged with and into subsidiaries of Global Net Lease. ARC Global 2 shareholders received 2.27 shares of GNL in the transaction, which closed at $17.48 per share for total consideration, which was 30% less than the $25 per share consideration investors ponied up to get into the deal. The $17.48 sale price reduction from the offering price reflects a fully loaded share of 12% and distributions during the life of ARC Global Trust 2 that exceeded cash flows from operations to the tune of approximately $50 million in the limited history of the fund. This works out to approximately $3.80 per share on the distribution side and puts you in the ballpark for $17.48. Subsequently, in February of 2017, GNL announced a 1-to-3 reverse split, and GNL currently trades at a 10% discount to the price at the close of the transaction. This transaction, which closed at a premium of approximately 25% to book value for ARC Global Trust 2 shareholders, was quite favorable at the time, given the condition at the time for ARC Global Trust 2's balance sheet, as it gave a bump to NAV and also provided liquidity for shareholders, given that the shares in GNL received as compensation were publicly traded at the time. Moving along, ARC RCA shareholders voted to merge into AFIN, American Finance Trust, in September of 2016. This transaction closed in the first quarter of 2017, and ARC RCA shareholders received consideration consisting of 0.385 shares of AFIN and a cash payment of 95 cents per share, which came to a sum of $10.26 in consideration per share, a slight premium to the initial offering price. Note this premium is exclusive of distributions ARC RCA shareholders received throughout its life cycle prior to the merger. Note that in light of recent distress across the retail sector, highlighted by credit pricing and syndicated loans and several publicly traded retail REITs exhibiting price weakness in the past year, this 2016 vintage deal was likely more favorable for ARC RCA shareholders than if the REIT was currently in the market seeking a deal. However, ARC RCA shareholders do not currently have liquidity as AFIN shares are not listed on an exchange. AFIN management has noted that efforts to beginning a listing of the shares began in 2015, but noted that market conditions have not been favorable for a listing as of late. Additionally, following the merger of ARC RCA into AFIN, AFIN has a portfolio currently consisting of approximately $3.5 billion in real estate assets, consisting of 516 properties that are geographically diversified with about 40% debt to total assets ratio. AFIN has also retained Lincoln Property Company to oversee the multi-tenant properties acquired from the merger with ARC RCA. Additionally, AFIN's portfolio currently consists of approximately 33% single-tenant net lease retail assets, 14% office assets, 13% distribution facilities, 31% retail power centers, and about 7% lifestyle centers. It is important to note that in the limited performance history following the merger close in the first quarter of 2017, AFIN distributions in the first two quarters of 2017 have totaled approximately $72.3 million. FFO over the same time period has been $52.8 million, and cash flows from operations have totaled approximately $41.4 million. This translates to a cash flow from operations payout ratio of approximately 175%. It is also important to note that beginning in the third quarter, AFIN announced a distribution rate decrease was authorized, which reduces the yield based on a $25 per share price from 6.6% to 5.2%. Given that third quarter financials have not been released, it is unclear to what extent distribution coverage has improved subsequent to the distribution rate reduction. With that backdrop, let's move into some more detail on a couple of AR Global sponsored programs with some pending shareholder actions required, namely ARC Healthcare Trust 3 and ARC New York City REIT, followed by an update on ARC Hospitality, which has subsequently been rebranded as Hospitality Investors Trust. ARC Healthcare Trust 3's offering began in 2014 and was suspended in November of 2015 in the wake of the RCS proxy issues. As the table on this slide highlights, ARC Healthcare Trust 3 raised approximately $171.1 million via its IPO and the distribution and proceeds from the distribution reinvestment program. This was deployed into approximately $129 million in gross real estate, and the REIT currently has cash and cash equivalents of approximately $13.7 million as of June 30th, 2017. Additionally, leverage on the portfolio is a mere 3.8% as measured by debt to assets. ARC HT3's board established an estimated NAV of $17.64 per share and released that NAV in an 8K in July of 2017. This estimated NAV per share was based off the consideration offered by Healthcare Trust, Inc. in a proposed asset sale, which was announced in June 2016. ARC Healthcare Trust 3 noted in an SEC filing that this established NAV per share may not be compliant for customer account statements under 1502 or under ERISA for qualified accounts, presumably as the NAV was not arrived at via the more traditional net investment methodology or appraisal methodology. The following table highlights cumulative distributions and payout ratios through the second quarter of 2017 for ARC Healthcare Trust 3. Additionally, note that distributions were suspended in July 2017 as a proposed asset sale has been put to shareholders for approval. Note that there's about a $13.9 million shortfall between distributions and cash flow from operations for a CFFO payout ratio of about 296% through the end of the second quarter. Let's take a look at some of the proposed terms of the purchase from Healthcare Trust, Inc. And note that Healthcare Trust, Inc. is an AIR Global affiliated program as well. The programs share management teams and have a common board member. In June 2017, a special committee of the Board of Directors of ARC Healthcare Trust 3 approved the $120 million all-cash transaction, including the assumption of approximately $5 million of HT3's debts. The consideration represents a 7.6% decrease from the original purchase price of the real estate assets within ARC Healthcare Trust 3's portfolio. Additionally, the consideration per share is approximately 71% of the original offering price of $25 per share for ARC Healthcare Trust 3 interest. However, the consideration reflects approximately 95% of the reported book value of ARC Healthcare Trust 3's balance sheet as of the end of the first quarter. This reduction reflects a fully loaded offering of 12% and the NAV reduction from cumulative distributions exceeding cash flow from operations, as previously mentioned. This, combined with limited gains on portfolio investments reflecting a shorter holding period and the purchase of assets a little later in the cycle, accounts for the valuation of the proposed offer. It's also important to note that this transaction price is approximately 22.8 times trailing 12-month FFO. If you adjust this for the $1.1 million ARC Healthcare Trust 3 has spent on external advisors to structure and evaluate the deal for the board, this comes to approximately 19.0 times trailing 12-month FFO. Based on annualized first quarter 2017 FFO, the deal is priced at 18 times funds from operation. The deal values a portfolio at an approximately 7.2% cap rate based on trailing 12-month net operating income. For a little context, Factrite has noted that medical office building cap rates have trended in the mid-6% range nationally as vacancies have reached all-time lows driven by favorable demographic trends and a favorable regulatory environment. Additionally, according to second quarter data from Lazard, FFO price multiples across the gamut of publicly traded REITs outstanding was approximately 16.8 times. This is not completely analogous as this is an asset sale, and ARC Healthcare Trust 3 has not achieved sufficient economies of scale and has a much lower portfolio size than the typical publicly traded REIT. However, based on this data, while ranging to the higher end of the cap rate range for comparable transactions, the purchase price is definitely within the ballpark of competitive pricing within the current market conditions. It is also notable that the board of ARC Healthcare Trust 3 engaged SunTrust Robinson to evaluate strategic options for the REIT, and no other options were presented, or no other options were disclosed. The deal remains subject to shareholder approval. So let's look at what some of the key takeaways are regarding ARC Healthcare Trust 3. First, you have this $120 million cash offer from an affiliated entity. Shareholder approval is required for this transaction to close. Additionally, there is a $3.6 million termination fee If shareholders reject the sale, this represents approximately 2.7% of total assets as of the end of the second quarter. Additionally, rejecting the offer will keep investors in the program, which has a closed shareholder repurchase program, and as of July 2017 has suspended distributions. It is unclear if and when distributions or the shareholder repurchase program would commence in the case of a shareholder rejection of the proposed sale. Further, Ark Healthcare Trust REIT has not raised capital since the RCS proxy issues and likely cannot raise additional equity capital in the current market, and has limited options to increase leverage to build out the portfolio, which makes it unlikely that the REIT will be able to achieve sufficient economies of scale with an external advisory agreement to be competitive in the long term. Moving on to Ark New York City REIT. Ark New York City REIT's IPO closed in May of 2015. It was fully subscribed to the terms of the prospectus with approximately 30 million shares sold. The share repurchase program was closed in July of 2017. Only repurchase requests from death and disability are currently accepted. This follows approximately 277,000 shares repurchased in 2017 at a weighted average price per share of $20.16, which represents approximately 1% of the outstanding shares. Distributions have totaled approximately $117 million since inception of the fund through the end of the second quarter of 2017. Over the same period, cash flows from operation have been negative. Total FFO and MFFO over the same period were respectively $6.4 and $9.1 million. This overdistribution in the past few years equates to approximately $3.80 on a per share basis, accounting for the lion's share of the reduction in NAV from the initial offering price of $25. Ark New York City REIT noted in its most recent 10-Q that we do not expect to generate sufficient cash flow from operations in 2017 to fund distributions at our current level, and there can be no assurance we will be able to continue paying cash distributions at our current level or at all. Additionally, earlier in October of 2017, the board of Ark New York City REIT voted to classify itself into 3 classes of directors, with each class elected in a different year and each class serving 3-year terms. This change increases timelines for shareholders to effectively influence management and is typically perceived as a defensive measure to thwart off activists and hostile takeovers. Additionally, Ark New York City REIT's board has recommended a swath of charter amendments, largely mirroring the 2016 proxy proposal charter amendments which shareholders rejected in the third quarter of 2016. The board notes that these proxy proposals are aimed to increase management's flexibility to achieve a strategic transaction. These proposals include charter amendments that reduce fiduciary obligation of the board to standards imposed under Maryland General Corporation Law, which require a director to perform duties in good faith and in a manner that he or she believes to be in the best interest of the company. Additionally, charter amendments would reduce shareholder access to records, including the company's stockholder list, and eliminate the ability of 10% of outstanding shareholders to calling a meeting and raising it to a majority threshold. These amendments would significantly increase barriers for shareholders to participate in governance and reduce the ability for shareholders to exert control of the company. Additionally, further charter amendments include elimination of a liquidation provision. This is kind of a tough issue in that the board, in recommending this proposal, notes that assigning an arbitrary deadline for liquidation may result in less than optimal returns for investors, as market conditions 6 years after termination of the IPO may not be conducive to an exit. It may require a longer holding period. Charter amendments also include the elimination of Article 14, which contains shareholder protections in the event of a roll-up defined as a receipt of shares in another non-traded entity, namely that shareholders are required the option to receive cash in lieu of non-traded securities, and requiring Ark New York City REIT to obtain an independent appraisal of portfolio assets, assuming an orderly liquidation over a period of 12 months. Additional charter amendments proposed would eliminate the prohibition in the current charter prohibiting multi-year advisory agreements and imposing a fiduciary duty on the advisor to the company and stockholders. Additionally, eliminating caps on advisor compensation, including acquisition and disposition fees. Further proposed changes include removing limitations on expense reimbursement payments from the company to the advisor. Additional charter amendments include eliminating provisions allowing for the removal of the advisor by the board with 60 days written notice. The elimination of these charter provisions may open the door for a prospective multi-year advisory agreement, perhaps a 20-year advisory agreement similar to those in place at Global Net Lease and American Finance Trust. Additional proposals would eliminate restrictions on private offerings of equity securities, which, if issued, may dilute existing interests and reduce the voting rights of existing equity holders. In the wake of the 2017 proxy proposals, Cove Partners, headed by Michael Ashner, urges shareholders to reject the proposals, opining that the 2017 proxy proposals erode significant shareholder rights and would entrench current management. Cove further notes that if shareholders want to retain the ability to select and hold the board and management team accountable, shareholders must vote in opposition to the proposals. Cove Partners has indicated that while they currently hold a nominal amount of shares in ARC New York City REIT, I believe it's 100 shares, any increase in their stake would be delayed until the proxy proposals have been voted down by shareholders. Cove Partners is notable in that Michael Ashner, who's leading Cove, is also the CEO of Winthrop Realty Trust and previously became involved with the management of New York REIT. As his firm, Winthrop Advisors, was appointed by New York REIT's board to serve as external advisor to New York REIT in 2016, ousting the previous advisor of New York REIT, which is affiliated with AR Global. This led to a change in key management personnel and to the addition of new board members. AR Global Management has criticized Mr. Ashner for not delivering on promises to shareholders in New York REIT, citing New York REIT's appointment of Winthrop REIT Advisors as its external advisor, and noting that Ashner had previously stated that a liquidation of the 19 properties in New York REIT could be completed within 6 months. As of October 2017, only 3 of the properties have been sold outright, as well as an additional 49% stake in a property was sold in, I believe, September of 2017. It's important to note that the most recent transactions New York REIT is engaged in occurred earlier in October of 2017. However, it should be noted that Winthrop Advisors was selected by New York REIT's board amongst 14 firms competing for the advisory contract, and that was announced in December of 2016, with New York REIT's board noting Winthrop's track record in liquidations, which include the Winthrop Realty Trust, which has been delisted and is currently selling off assets in a liquidating trust. As previously mentioned, Winthrop Advisors was appointed by the board in December of 2016 and began its advising of the REIT on March 31st, 2017. So it's just eclipsed the 6-month mark now. As the chart on this page indicates, investors should note that New York REIT's stock closed at just over $10 following the announcement that the board was seeking strategic alternatives in August of 2016, and shares have traded down approximately 23% through yesterday. Recently, though, there have been some increases in institutional ownership of New York REIT shares, including Citigroup acquiring a stake. Kind of getting back to ARC New York REIT, it is important to note that Michael Ashner's firm, which has a history with a previous AR Global sponsored REIT and was subsequently appointed as advisor of New York REIT, has publicly opposed the ARC New York City proxy proposals and recently was critical of the board's decision to classify itself. One final note on ARC New York City REIT. In late September, ARC New York City REIT filed an 8K highlighting that the independent election inspectors for shareholder voting of the proxy proposals noted that due to the fact that proxy proposals are contested, certified voting results were not available at this time. However, ARC New York City reported that the election inspectors delivered preliminary results indicating that the proxy proposals failed to obtain requisite shareholder approval. ARC New York City REIT has challenged the preliminary results, noting that it believes the preliminary results failed to give effect to a number of votes on each of the proposals. No further clarification has been given on the next steps or when certified results of the proxy proposal votes will be available. So what are the key takeaways on ARC New York City REIT right now? First, cumulative distributions have exceeded cumulative cash flow from operations, contributing to the NAV erosion. Second, ARC New York City REIT has noted in its Q2 10Q that we do not expect to generate sufficient cash flow from operations in 2017 to fund distributions at our current level, and there can be no assurance that the REIT will be able to continue paying cash distributions at our current level or at all. Third, the estimated NAV per share of $21.25 was established on June 30th, 2016. This is which highlights the reduction attributable to the fully loaded offering of the shares and the cumulative distributions exceeding cash flow operations. That's primarily contributed to the erosion of the NAV. Additionally, the shareholder repurchase program has recently been closed, and the board recently availed itself of Maryland General Corporation law and classified itself staggering elections of directors over a 3-year cycle. And finally, the uncertainty regarding the fate of the proxy proposals following ARC New York City REIT's challenge of the preliminary results from the election inspectors. That provides you with a little highlight of some of the programs that have or have had recent shareholder input required. Now let's turn our attention to Hospitality Investors Trust. ARC Hospitality raised approximately $885 million in gross proceeds through the IPO and distribution and proceeds from the distribution reinvestment program prior to the cessation of its equity raise following the RCS proxy issues in 2015. ARC Hospitality levered this capital raise into a $2.3 billion hotel portfolio encompassing approximately 17,000 plus keys. ARC Hospitality was quite highly levered from the beginning and acquired $2 billion of hotels in 2015 alone. Debt to gross properties was approximately 73% at the end of 2015, and as of the end of the second quarter of 2017 was approximately 70%. Towards the end of 2015, ARC Hospitality terminated an $89 million portfolio acquisition of 10 hotels and forfeited approximately $9.1 million in earnest money deposits. At the close of the equity raise of ARC Hospitality left the REIT with insufficient funds to close the deal. This set the stage for Brookfield Asset Management's investment in ARC Hospitality. Brookfield is a Canadian asset manager with over $250 billion in assets under management. They focus primarily on international real estate, renewable energy, and infrastructure development. Following Brookfield's investment, an estimated NAV per share of $13.20 was established, significantly below the previously estimated NAV per share of $21.48 as of March 31st, 2016. The reduction in NAV is attributable to 3 factors. Increased PIP expenditures, property improvement plan expenditures, from previous estimates in the previous valuation, including future PIP obligations, and increased impacts on the leg of hotel rooms being offline to accommodate PIP work from the previous $21.48 valuation per share. Secondly, higher capitalization rates on exit scenarios were used in the most recent valuation, reflecting a slight increase in the interest rate environment from the previous estimated NAV calculation. And third, an approximately 8% increase in the number of shares outstanding due to issuance of shares from the distribution reinvestment program. The total DRIP issuance over that time was approximately 3 million shares. Also note that the shareholder repurchase program closed in January of 2017, and that distributions have been suspended on common stock as the REIT seeks to shore up its balance sheet. Proceeds from the $135 million placement of Class C units to Brookfield and subsequent draws, which could total out to about $400 million, will be used primarily to repay preferred equity interests held by private equity funds sponsored by the Merchant Banking Division of Goldman Sachs. Note the preferred equity interests from Goldman Sachs have maturities in 2018 and 2019. Secondly, proceeds from Brookfield's investment were used to complete an acquisition with Summit on a portfolio of 7 hotels during the second quarter of 2017. And 3, to finance any excess available to finance additional property improvement plans on existing portfolio assets. Further, note that Brookfield is obligated to purchase an additional $265 million with proceeds anticipated to be used to repay the remaining Goldman Sachs preferred equity interests and hotel mandated PIPs. Note the Goldman preferred equity interests outstanding as of the end of the second quarter of 2017 were approximately $241.4 million. It's notable that these Class C interests that Brookfield has acquired are convertible into operating partnership units with a conversion price of $14.75, which is above the estimated NAV that was recently disclosed, and the operating partnership units may subsequently be converted into common stock on a one-for-one basis at Hospitality Investors Trust election. Note the Class C units include cash distributions of 7.5%, which began in June of 2017, and can increase to 10% if distributions are not fully made on the Class C units. Additionally, the Class C units include PIK distributions of 5%. If redemption of the Class C units does not occur within the next few years, the PIK interest will increase to 7.5% and an additional 125 basis points per quarter that a redemption does not occur until a maximum PIK rate of 12.5% is reached. At the time of the initial closing of issuance of Class C units with Brookfield, the advisory agreement was terminated and Hospitality became internally managed. Note that the same senior executives remain in place following Brookfield's investment. However, Brookfield's investment granted Brookfield significant governance changes to Hospitality, namely that it received 2 seats on a board which has expanded from 4 to 7 directors, and it granted Brookfield approval for corporate actions including equity issuance, organizational document amendments, debt issuance, affiliated transactions, sale of assets, declarations of distributions, redemptions of securities, and the hiring and compensation of executives. Additionally, late in the second quarter, Hospitality Investors Trust refinanced $1.2 billion of outstanding mortgage debt through a $915 million mortgage loan and mezzanine financing of approximately $310 million. The financing includes extensions that will push out the maturity dates on this financing to 2022. Management has noted that the refinancing reduced its cost of capital, allowed for the closing of 7 hotels during the second quarter, and provided stability by pushing out the maturities. Note that with the refinancing occurring in the latter half of the second quarter, the anticipated interest expense savings are not completely baked into the second quarter reported results. So what are the key takeaways for Hospitality Investors Trust? First, the Brookfield investment stabilized the REIT and provided the backdrop for the refinancing of mortgage debt achieved in the second quarter of 2017. It also allowed for the closing on additional hotel acquisitions during the second quarter. Additionally, Brookfield's obligation to make future purchases of additional Class C units will offset the maturities on Goldman Sachs preferred equity interests in the REIT, while also providing funding to finance additional property improvement plans on existing portfolio assets. Note that the REIT remains highly levered. As previously noted, this was 70% debt to assets as of the end of the second quarter of 2017, and hospitality performance has been buoyant as of late. Note that a changing of fortunes in the industry may materially hinder the REIT's performance and ability to meet its debt obligations. Other developments include the January close of the shareholder repurchase plan and the cessation of distributions to shareholders with no additional distributions anticipated for 2 years as the REIT shores up its balance sheet. I know with that, I'd like to conclude our presentation. I know there's a lot of material here. There's not really enough time to go through everything that's been occurring, and I encourage you to reach out to me if you have any additional questions or comments related to any of these programs or any of the other programs outstanding. I'd be happy to respond to you and help you in any way, shape, or form with your ongoing due diligence on this. With that, I'd like to thank you again for listening in, and have a great day.